Welcome to Bloomberg ETF IQ. I'm Katie Greifeld here with Eric Balchunas. Eric, I'm a little bit thrown off. We're in a different studio than where we normally are.
We are. It's kind of cool. It feels like Star Trek in here.
It does. Feels pretty good. We're only here for 2 weeks while the other studio is under construction, so we're going to make the most of it. Let's get to the biggest stories right now in the more than $12 trillion global ETF industry. NVIDIA, it's dipping after a strong post-earnings rally. We're going to speak to the CEO of GraniteShares in just a few moments to discuss why he thinks it's the most important stock in the world. Plus, ETF investors seem to be tired of fighting the Fed as trading slows in the days leading up to the decision. And we're also going to speak to Dina Ting of Franklin Templeton to discuss how U.S. investors are overcoming a home country bias in their asset allocation using ETFs. But as always, before we get there, Eric is looking at these flows. Eric, what do we got?
Yeah, so look, Katie, if you look at the weekly flows, you have sort of a tug of war that's taking shape here. On the upside, you're going to see flows into the Qs and then VU, right? That's the Vanguard bid that always comes in. And the Qs, that's sort of a techie bid, NVIDIA driven. More on that in a minute. IBIT, interesting. That's a big week for IBIT, which just passed GBTC as the largest Bitcoin ETF, and it will probably never look back. I think it'll be the largest one for quite a while. On the outflows, though, here's the bad news. You're going to see a lot of money coming out of SPY, LQD, IWM can't catch a break. Small caps continue to struggle, and even Soxel with some outflows. So you balance those two things, it was more of a net neutral week in flows. But let's look at the Qs. This is interesting, right? NVIDIA is the third largest weighting in the Qs. And you can see the flows after NVIDIA's earnings on 5/22 when it had that beat. The flows went right into the Qs, right? And they also went into QQQM. So they were very linked. NVIDIA, third largest stock in that index, but to me, the spiritual leader for sure, and the biggest contributor of the returns over the past couple of years. So not surprised to see NVIDIA basically saving the day once again. It would be worse if that didn't happen.
Well, let's keep the conversation going on NVIDIA, because joining our conversation now, I'm pleased to say, we have Rhind. He is the CEO of GraniteShares, joining us in this fancy studio. It's great to see you.
Great to see you too.
Let's talk about your ticker, NVDL. That is the GraniteShares 2 times long NVIDIA daily ETF. So it's double leveraged on NVIDIA. It's up close to 1,500% on a total return basis just over the past year or so. Eric actually pointed out on Twitter earlier that it's doing, what, $1 billion a day in turnover. So my first question to you would be, who's behind it? To what extent is this retail really showing up here?
I think it's a large part of it, like all ETFs these days, and particularly when you get a successful ETF, that you have retail being a big part of it. But if you look at the holdings data for NVDL, you'll see anybody from the large retail brokerage to the most sophisticated hedge funds and trading firms in the world, and it really spans the whole spectrum.
And why, though? Is it just convenience? When I wrote my first book on ETFs, I kept coming back to convenience as an advantage. People just like stuff that's easier, even if it's a little bit easier, right? You get the stock, but you get it 2x. You click one button and you have the trade on it. Is it just because it's that easy? Because a pro could do that pretty easily, so why would they use this ETF?
So there's two elements to it. One, and this is the slightly glib answer, if you love NVIDIA, you're going to love 2x NVIDIA even more. But realistically, what we're providing, Eric, is institutionally priced leverage to the masses. And that's the big sort of breakthrough, is that for individual investors or even professional investors to obtain leverage, that is very difficult to do. There's a lot of implications with that. But the financing cost is just a lot less expensive within the ETF wrapper.
So we look at the single stock ETFs. There's dozens of them on the market. You're not the only issuer. And there's a direct correlation between the amount the stock trades. Like NVIDIA every day is the most traded equity, more than it took over Tesla, I don't know, about 6 months ago. And now that's the most popular 2x ETF. Then they do the covered call on top of it. Are we going to see this cycle of whatever stock is popular in the top 2 or 3? They're going to make a whole ecosystem of like easy to do trades around that stock. Seems to be that's where we're heading.
I think that's it. I mean, that's where you got to go where the enthusiasm is. So if we were having this conversation 3 years ago, I would say we'd be talking exclusively about Tesla. And that was where the enthusiasm was. That was where all the flows were. In Europe, for example, we had a Tesla product was by far our biggest one. Now, obviously, the whole conversation is dominated by NVIDIA, and that's why I think NVIDIA is the most important stock in the world right now. So goes without saying, we're going to get an ecosystem around NVIDIA just like we've seen in other stocks.
And it's really interesting, like you point out, that sort of changing of the guard when it comes to the hype cycle. Right now, it's NVIDIA. And you mentioned, I mean, in providing these ETFs, it provides what institutional class leverage to retail players. It'd be easy to really build like a fear-mongering case around that. A lot of pearl clutching over whether retail investors should have access to that sort of leverage. Because, of course, for NVDL, which is up 300% year to date, you also have the inverse of that. Of course, you have the GraniteShares 2x short NVIDIA daily ETF, which is down about 88% on a year-to-date basis.
Yeah, so I mean, I think you mentioned it in the opening, which is NVDL is up 1,500%, right? And we don't charge 2 and 20. So it's incredibly inexpensive way to generate outsized performance. But with leverage comes risk. And of course, these products are not without risk, just like any leveraged instrument. And I think the important part is that, you know, for sort of retail, it's not necessarily inexperienced retail because there's a suitability requirement at almost all brokerages to buy leveraged products. So it's not like you can just open an account and start trading these. So these are typically permissioned for active investors or active traders only. And so you get investors who are comfortable taking leverage, you know, a lot of the same people that use perhaps options or certainly invest or trade in the cryptocurrency markets. So a lot of those types of profiles up to, like I said, the most sophisticated hedge funds and trading firms in the world.
So yesterday you turned some heads. You filed for a whole new brand called Yield Boost. This seems to be a competition to YieldMax, which is a different firm that's had a huge hit. They write call options right out of the money. So you get a lot of premium, but you give up a lot of your upside. You're now going to do these on some leverage ETFs and some single stock with leverage. Obviously, what kind of yields are we looking at, and is there any kind of danger here?
Well, I mean, I think it builds off of the ecosystem comment that you just made, which is that once you start to get investor interest around a particular category, and in this case, it's alternative income, and we've already learned that by doing whether put write strategies or call writing strategies, you can generate a lot of income. Now, clearly, you're giving up some upside in the case of some of those strategies as well, but all things being equal, the more volatility you have, the more income you should be able to generate. So it's just an extension of that, really. And for those that are really looking for income plays, it's already proved that this is a popular category and this is the next level of it.
I actually want to talk about tickers because I believe we were having a conversation with Mike Venuto a couple weeks ago. If it wasn't Mike Venuto, I'm sorry, but he said there isn't necessarily a ticker shortage out there, but there could start to be for some of these single stock ETFs, since if you're basing it off a single stock, there's only so many ideas that you can use there. So you filed for 25 in a single day. You haven't listed tickers yet. Do you think that there could be a ticker shortage when it comes to especially these single stock products?
I think already there has been for some years. I mean, if you look at even Eric mentioned at the beginning about our gold ETF bar. So what most people don't know is that's a really cool ticker, but that was actually a ticker that was used on a failed ETF beforehand. So that was already on an existing ETF. The ETF failed. We then took over the ticker because our timing was right. The ticker became available. But I would say for years that for great tickers, they're a massive premium.
So what's going to happen? I mean, is there going to be some sort of shadowy market for tickers? How does this evolve, basically?
I think it evolves in terms of adding different computations to the actual ticker profile. So we've gone from sort of 3 characters to 4, maybe it goes to 5, or maybe you put in some numbers as well. I mean, that's obviously something for the exchanges to consider. But if you look at those, those really important tickers, I'd say it's already a premium.
Eric, can you imagine numbers in an ETF ticker?
Well, they do that. Well, in Asia, it's all numbers.
Yeah.
It's really you can hardly remember them.
Europe, you have it.
And there's some numbers in Europe too.
I can barely remember my cell phone number, so that would be a disaster for an ETF reporter, but we're going to have to leave it there. Really appreciate your time today. That, of course, is Will Rhind of GraniteShares. Now coming up, fighting the Fed, why a slowdown in ETF trading leading up to the central bank's decisions signals that investors, they're getting tired of predicting when rates will be cut. This is Bloomberg. Welcome back to Bloomberg ETF IQ. I'm Katie Greifeld. It's time now for the ETF brief, where I walk you through the trends and the stories that caught my eye in the ETF industry. And we start with the flippening, at least when it comes to Bitcoin ETFs, because BlackRock's IBIT, now the largest Bitcoin ETF in the world, it overtook GBTC yesterday in the most recent data that we have. Really interesting, as you can see on that chart there. It's been a really dramatic narrowing over the past few months. Of course, IBIT has only been around since January, but that's what the BlackRock brand name and, of course, its distribution will do there. Let's also talk about bonds. From Bitcoin to bonds, we're going to talk about TLT here, because a big inflow into TLT yesterday, about $1 billion coming in a single day. That is the biggest one-day inflow since last December, I believe. And it's interesting that even with that big inflow that we got, $1 billion for the year net, it's looking at an outflow of about $100 million. So clearly appetite has soured for long duration bonds this year. And let's keep the conversation going on bonds, because, Eric, there was a really interesting piece out from Athanasios Sarafagis, who rumors say that he's in this studio right now. We're going to get to him. But before we do, let's highlight this chart. It's interesting. It really highlights how tired investors have gotten about the Fed, that leading up to the Fed, you don't see the most volume there anymore. Now it's the days after the Fed. Maybe shows that investors are tired of trying to predict where rates are actually going to go.
Yeah, absolutely. I mean, we have, don't fight the Fed. It's a famous phrase. The Fed typically wins. And you wrote a piece that is really great about this. TLT is the ultimate Fed fighting ETF. Explain.
Yeah, and so last year it was like the hottest trade, right? Like 22 billion or so came into that ETF. And I feel like the confidence level of people fighting the Fed has changed. Like the beginning of the year was, we're going to get rate cuts in March. Then it's June. Now it's like no rate cuts. Now there's like a rate hike potentially coming. So when you look at how sentiment has shifted around TLT, I feel like people were more confident heading into the Fed days. They were trading that quite a bit. All bond ETFs were trading, but especially TLT. Then you sort of saw it shifted towards on the Fed days. Now they're kind of waiting for all the information to come in before they're trading. So I think it just speaks to they're less confident about what the Fed is going to do. I think they're less hinging on like some of the words of the Fed chair and whatnot. But I just think that people have gotten fatigued of fighting that trade.
Feels like everyone's tired. Investors, consumers, anchors, etc. But let's talk a little bit about where they are sending money, because maybe it's not going to the long end. I mean, outside of what we saw yesterday in TLT flows, but the short end is still pretty popular here.
For sure. And I think it was on this show, Rick Reeder had said, clip coupon and just like wait. And
yeah.
I love that quote. And I think that's what everyone's doing. You're still getting 5% or so in bill. It's been a pretty good trade. Why start fighting the Fed and figuring out what they're going to do? You have it pretty nice in like bill and the short duration stuff. And that's where most of the money is going in bonds.
Yeah, and I think that's the difference between a money market mutual fund or SHI, which is the short end, is that that's just for income. You're not going to TLT for income because you get the same amount with taking no duration. This is a bet. And people sometimes talk about TLT being like a retail trade, mom and pop, but almost 80% of it is accounted in the 13Fs, meaning it's mostly pros. Would you say this is a lot of pros making this bet who are seduced by this trade?
Oh, yeah, for sure. I don't think retail is like really looking at TLT. I think also just the magnitude of the flows that goes into it, I think speaks that it's very institutional too.
I do want to switch gears, actually. I want to go back to tickers. I thought that was so interesting, that conversation we just had with Will Rhind, because it was also a piece of your research highlighting that we could see a ticker shortage. It seems like, according to Will Rhind, it's underway, at least when you look at the single stock products. What about the world at large when you take a look at broad brushstrokes, the ETF industry?
I think, yeah, I get it. There's 26 letters, and so there's a lot of combinations, but you want it related to your ETF, right? So I think in that aspect, there is going to be a shortage. But then I think something you had mentioned, it'd be interesting to see closed ETFs if they come back, or if there's offers for tickers that that issuers might be sitting on. I think that's definitely, it sounds a little ridiculous, but I think it's going to be a real thing, that there's going to be fights over tickers.
Maybe there will be sort of like a back alley shadow market for ETF tickers. That would be a lot of fun to cover. So I don't know if I'm rooting for that, but in any case, Athanasios Sarafagis of Bloomberg Intelligence, thank you so much. Still ahead, we're going to drill down into dividends with Dina Ting of Franklin Templeton. That conversation coming up next. This is ETF IQ on Bloomberg. This is Bloomberg ETF IQ. I'm Katie Greifeld along with Eric Balchunas, and it's time for today's drill down where we focus on one ETF. Eric, take it away.
Yeah, thanks, Katie. Today we are looking at DIVI. DIVI is the ticker. It's a Franklin International Core Dividend Tilt Index. So the core means it's something you can use in your core. It looks at mid and large cap stocks that are not in North America. Tries to balance high yield with the dividend, but also some capital appreciation. And the tilt is like we are going to tilt a little bit. So even though it's passive, it is sort of like a smart beta ETF. And you can see there it's 820 million. That's pretty big for a dividend ETF because there's like so many. The competition's fierce here. And the fee is 9 basis points. That's dirt cheap for this kind of strategy. That's probably why it's successful so far. Let's look at the holdings. One of the reasons this has done well, in my opinion, is that Novo is the top weighting. Yet it's only 2.5%, which brings me to the other weightings. You can see how it's like equal weighting. That's going to give it a little more zip, and you're going to get a little more, say, small cap or small or large cap exposure here because of that. And then let's compare it to some other big international dividend ETFs out there. This is what really matters because there's so many of these. You have to outperform to stick out, and this one has. Over 5 years, DIVI is up 63%, the Vanguard is up 43%, and then the Spider is down. That could flip. I'm not trying to disparage the other ones, but that 5-year performance there, Katie, is obviously a big part of this. Throw in the 9 basis point fee, and it's no surprise this thing's closing in on $1 billion.
Eric, thank you. And joining us now to talk about this ETF, I'm pleased to say we have Dina Ting. She is head of Global Index Portfolio Management over at Franklin Templeton. I want to talk a little bit about portfolio construction here because you point out in your notes that not all of your holdings in a dividend portfolio need to necessarily pay very high dividends. How do you pick and choose which stocks actually go into this ETF?
Yes, I think that's what's unique about this income strategy. Typically, when someone crafted or constructed a portfolio with a tilt into income, all they care about is the dividend yield. In this case, we want to balance the income and the capital appreciation, which means that we believe that the sum of its part is better than the individual. And what that means is we're able to put in companies that has a higher capital appreciation, even though they're not paying a high dividend, and combine that with the company who may have a lower expectation of return with the one that is paying a higher dividend. So the combination of its part is the one that makes this one very effective. At the end of the day, this is maximizing yield per unit of active risk, right? Because we don't want to deviate too much from the benchmark that is benchmark against, whether that's a developed market, but also give you that extra tilt without sacrificing total performance.
And Dina, as I went over, this performance has been really good. So that obviously is going to help your case. But international ETFs, if you're in the U.S., haven't been that attractive to investors, even though many countries are hitting all-time highs. It's just not as good as the U.S. So it's been tough to get people to bite on the international part of this trade.
Correct, Eric. I mean, the story about international with the U.S. being so strong the past few years, but I think it's probably not the time with international, and you can see it when you look at performances of last year, right? People tend to lump international as one, but if you look at single country, some country really perform strongly. For example, last year, Mexico was performing strongly. And then this year to date, Japan, especially the Japan hedge, has been performing strongly. Part of the reason why DIVI has been having the performances that you highlighted is because on top of the Novo Nordisk that you highlighted, it also has a few of the names that is helping in the artificial intelligence powering the longer term team. If you look at all the earnings call, you're hearing people are spending more and people trying to build the semiconductor chip manufacturing that's powering artificial intelligence behind that. But if you look at some of the individual names within DIVI, ASM Lithography, and then the Disco, Advantest, they are companies that power that semiconductor ecosystem. Even though they are not particularly manufacturing the chip itself, they are the equipment that help build those manufacturing firms. So they are kind of like the beneficiary. Just if you look at the analogy, the automotive, the auto parts, semiconductor, this is the semiconductor equipment and tests that helps.
And I want to go back to sort of when you talk about where you add new holdings to this fund, because, I mean, we're just through the real heart of U.S. earnings season, and you saw a lot of companies come out and boost their dividends. How often do you rebalance? Do you add things? Do you take money, or not money, actual shares out of this ETF?
We do that on a quarterly basis. So on a quarterly basis, we're doing the rebalances to first look at companies that are adding dividend, as you said, but also balance that throughout. Because what's probably unique about this dividend strategy is the fact that we took a very conscious effort on the active risk, right? So which means we have constraint on the sector, on the country, as well as on the turnover itself, to make sure that it's delivering what we try in terms of the objective, maximizing yield per unit of active risk.
And if we look at the actual yield, the only thing that sticks out is this is only 10 basis points more yield than EFA, which would be sort of the bigger benchmark. That's 2.94%. Yours is 2.8%. Is that a challenge? Do you, to entice investors, do you need a little more juice than that?
I think our strategy when we come in with the ETF at Franklin Templeton is we want to kind of disrupt the industry, whether through a cost or through a performance or through a combination of both. So in this case, we offer investors, you get that tilt of income, but you don't have to pay that much extra for that. And I think that's the reason why we see the success of this strategy. This is one of those dream ETF where you actually see like organic growth. For like the past year and a half or so, we see creation almost on a daily basis. It's small, but it's growing, which just shows that it's truly organic. It's not just a handful of big investors, but there's a lot of people who like this strategy, right, and showing that by the activity of their flows.
All right, Dina, really appreciate your time. That is Dina Ting of Franklin Templeton. And if you just can't get enough of ETFs, reminder to tune into the new Tiger Money podcast that'll guide you through Asian financial markets. A reminder that we're back on Monday next week. That does it for Bloomberg ETF IQ. This is Bloomberg.